There is a line in the tax code that lets you take money out of a workplace retirement account years before 59 and a half, with no early withdrawal penalty at all. And there is one ordinary piece of paperwork, the form almost everybody signs in the month after leaving a job, that destroys it permanently. Most people who lose this rule never find out they had it. It is usually called the Rule of 55, a nickname, not a government term. In the tax code, it is Section 72T, the separation from service exception. Here is the rule in the IRS's own words. Listen for the year and for the word separation. The 10% additional tax does not apply to a distribution made after separation from service if the separation occurred during or after the calendar year in which the participant reached age 55. Calendar year, not your birthday. Turn 55 in November of 2026, walk out the door in March at 54, and you qualify. The rule looks at the year, not the date, and separation, not retirement. You can quit, be laid off, be fired, or leave to start something of your own. The code asks only whether you separated from that employer. For two groups, the age is different. Qualified public safety employees in a governmental plan use the earlier of age 50 or 25 years of service. That covers police, fire, emergency medical services, corrections, and certain federal officers. Under the Secure 2.0 Act, so do private sector firefighters. Now, what this rule does not do, it removes the penalty. It does not remove the tax. Every dollar out of a traditional 401k is ordinary income in the year you take it, exactly as if you had earned it. Let me put real numbers on that using 2026 figures. Say you are 56, single. You left your job this year and take $70,000 from that employer's 401k. Assume it is your only income. The standard deduction for a single filer in 2026 is $16,100, leaving taxable income of $53,900. The first $12,400 is taxed at 10%, $1,240. The next $38,000, which takes us to $50,400, is taxed at 12%, $4,560. The last $3,500 at 22%, $770. Add those together. Your federal income tax is $6,570. On a $70,000 withdrawal, that is an effective rate a little under 10%. Now add the penalty you just avoided. 10% of $70,000 is $7,000. So the penalty alone would have been larger than your entire federal tax bill. It would have taken that withdrawal from $6,570 to $13,570. More than double. That is what this rule is worth. Here is how people lose it. The first way is the year you left. The exception attaches to the separation, not your age when you withdraw. Leave at 53, come back at 57 for the money, and it is still a separation that happened at 53. Waiting does not repair it. The second way is which plan. The exception covers the plan of the employer you separated from. A 401k at a company you left at 48 is not covered by the job you leave at 56. Two accounts, two separations, two different answers. It covers one. The third way is your plan's own rule book. The tax code permits this withdrawal without a penalty. It does not require your old plan to offer it. Whether you can take partial withdrawals, monthly installments, or only one lump sum is set by the plan document, and that document differs at every company. Ask for your summary plan description. They must give it to you free of charge. And then there is a fourth thing. less a disqualification than a demolition. Roll that 401k into an IRA and the exception is gone. That is not an interpretation. Section 72T shuts this exception off for individual retirement plans. The IRS says so in the notice your plan must hand you. The age 55 exception does not apply to payments from an IRA. The money has not changed. Your age has not changed. Only the account it sits in has, and the exception does not travel with it. Inside an IRA, you are back to waiting for 59 and a half. It can happen without you asking to. A balance of $7,000 or less can be pushed out of the old plan, and anything over $1,000 goes to an IRA unless you say otherwise. One account type escapes all of this. A governmental 457B plan is free of the 10% additional tax at any age after you leave that employer. Except money rolled in from another plan or an IRA. If you have already rolled to an IRA, you are not out of options, you are out of this one. Substantially equal periodic payments, a fixed schedule you commit to, is a separate exception that works from an IRA. But payments must run for the longer of 5 years or until 59 and a half. Break the schedule and every penalty you avoided comes back with interest. So if you are leaving a job in or after the year you turn 55, the question is not whether to roll your 401k over, it is when. If you may realistically need money from that account before 59 and a half, it would be favorable to leave that portion in the plan. Roll the rest whenever you choose. The exception waits for you. It does not wait for the money. If instead you have income to carry you to 59 and a half, this rule may never matter to you. Two things that will surprise you when the money arrives. When the plan pays you directly rather than rolling it over, it must withhold 20% for federal tax. On that $70,000, $14,000 is held back against a bill of $6,570, refunded when you file. And check box 7 on your Form 1099-R. Code 2 means the plan told the IRS an exception applies. Code 1 means it did not, and then you file Form 5329, Exception 01, one form to protect $7,000. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing. Subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.